long-term average borrowing costs. Unfortunately, that's one of the main reasons why we're going to keep printing money, because our economy is so sick that it can't function without it. And basically, I hope this chart here will explain just how absurd the solution has become. I can't do it from this side here. This image here represents the United States Treasury, whilst we've obviously got the image of the Federal Reserve as well. The system as it stands right now works something like this. The Treasury obviously wants to spend money into the real economy. They don't have any money of their own though, so they need to issue debt. So the Federal Reserve prints money to give to the United States Treasury. And in return, the Treasury sends a bond that goes and sits on the balance sheet of the Federal Reserve. Obviously, those bonds have coupon payments though. So the United States Treasury offers a coupon payment to whoever buys those bonds. And those coupon payments get sent over to the Federal Reserve as the owner of those bonds. But the Federal Reserve is very happy to try and make it look like the US budget deficit's not as bad as it really is. So what in fact happens is the Federal Reserve actually sends all the interest back to the Treasury so that the deficit doesn't look as bad as what it really is. It's not an insignificant sum either, guys. On a $4 trillion or a $3.5 trillion balance sheet, this numbers are basically $100 billion a year now that goes into the US Treasury to make their deficits look less bad than what they already are. The beauty of the system gets even better though, because what that basically means, the Federal Reserve, if their balance sheet themselves, they're a private bank essentially, if their balance sheet gets in any trouble, they are allowed to actually borrow money from the United States Treasury with money that they will print themselves to start with. It is a completely crazy and ridiculous system, and it's not going to work, but we're going to keep trying it for a little bit longer. And fundamentally, one of the things that we all should really be questioning as well is, do we really want governments to be doing this with our money and intervening to this level in our economy? Because everyone is telling us right now that, as I said earlier, we need more government spending because the private sector is so weak. But have a look at how large the government has grown in our society across the course of the last basically 100 years. Back in around the time of the First World War, government spending was only about 5% of our economy. Now, government spending is closer to 30, 35%. In other countries in Western Europe, it's higher. It's more like 50%. This is not a good thing, guys. Private sector spending, private sector job creation is what adds to the prosperity of a nation. It's not to say that government spending is all bad, but it is generated and it is generally implemented for political gain rather than economic gain. And what that means is, unlike the private sector, which has a huge incentive to be able to produce more than the sum of its parts, otherwise each and every business would go bust, government doesn't operate like that. And that is why what we've seen as government's percentage of GDP has got bigger, the efficiency of our economy to turn debt into productive output has fallen. And you can see that by looking at this chart here, which basically shows for every dollar of debt that we're going into, how much productive output we're getting from it. As government gets bigger, the marginal productivity of debt continues to fall. This is a perfectly logical outcome, and it basically goes to show, or should help to illustrate, why our economies are not going to get healthier while we continue to print money and while we continue to encourage government to meddle more and spend more as a percentage of our overall output. And reality is, not only does it logically make sense that it's not working, the data kind of doesn't lie either. And before I get to that data point, sorry, I forgot I put in this slide in here, I want to perhaps explain it. Well, I'm not sure whether any of you guys have ever heard of Milton Friedman's 4 ways of spending money, but the way he explained it makes perfect sense going on from what I was saying before. He basically said there are 4 ways you can spend money, and the first is that you can spend your money on yourself. And if you do that, you're going to make sure that you don't spend too much and you get very good quality for what you spend your money on. Second way you can spend money is that you can spend your money on someone else. Maybe you buy them a birthday present, was I think the example he gave. And in that case, you might not worry so much about the quality of what you get, but you'll definitely make sure you don't spend too much. Third chance, or the third way, is that you can spend someone else's money on yourself. And any of us with a corporate credit card do that at every opportunity we possibly can, and we don't eat at McDonald's, we eat at Cafe Sydney. And the last but by no means least way you can spend money is you spend someone else's money on somebody else. And if you do that, you don't care how much you spend and you don't care what you get for it. And in Milton Friedman's words, that's exactly how the government spends money, and that was 40% of the economy at the time that he was talking about it. That's why we're not going to get wealthier, our society's not going to get more prosperous, our economies aren't going to recover while we continue down this path. And, sorry, this was the slide I thought I was going to before, we can see that it's not working. This is global GDP since 1998. And you can see before the GFC hit, we were running along at an average of probably around 3.5% of GDP, a little bit cyclical, obviously. Then we have this huge crash. Then we have a little bit of a pickup. But you can see what's been happening since 2010. We've been spending all this extra money. We've been printing all this extra money. But the actual amount of output that we're generating is declining. Yes, we're growing by a little bit, but it's not by anything that justifies the level of debt we're going into or the amount of money we're having to print to keep this system going. To give you an explanation of what it might look like to actually try and stop it though, it would look something like this. In 2012, US government deficit was $1.1 trillion, equivalent at the time to about 7% of GDP. Now the IMF estimates that $1 in spending cuts will equal about $1.50 in contraction in GDP. Makes perfect sense. Obviously, it doesn't work dollar for dollar. There's a multiplier effect. If you cut spending, that impacts someone else's income and their ability to spend. So if the United States government was to say, yep, you know what, we are on a dead-end path, we need to stop spending, we need to stop printing, we need to start living within our means, a balanced budget would basically lead to a $1.65 trillion reduction in output, which would be equivalent to about 10% of GDP. And that's a best case scenario, guys. That wouldn't pay back $1 in debt. It wouldn't reform social welfare or social spending entitlements. That's the reality of the challenge that we face if we are to stop doing what we're doing. What we're doing is not working, but the reason why we continue to do it is because there is no politician in the Western world that will get elected or keep office if they propose anything even remotely approaching this. That's why I know obviously we've got an election coming up in a couple of weeks. I'm not sure how political anyone is here in the room tonight, but neither party is presenting a credible plan to return us to anything even approaching a surplus in the next 10 years. And all of them are using exceptionally rosy economic projections, even in these highly questionable numbers that they're producing. And that basically leads to the last fact I want to talk to about the economic situation we face now, which is the fact that we aren't immune from this down under. We were hugely fortunate during what I would call round one of the GFC that the Australian economy didn't fall into recession. But we have a private sector debt burden in this nation that is significantly worse than the OECD average, countries like the UK, the US and Spain. Significantly worse. And nearly all of it is tied up in our housing market. We have a manufacturing industry that's been in outright contraction for three and a bit years. Consumer confidence figures are fairly weak. Job ads in Western Australia, for example, which has obviously been the highlight of our economy the last decade, job ads are down 45% in the last year. And they're basically back at GFC lows all around the nation. Investment intentions all around the economy are weak. They're recessionary. Basically, no one wants to hire, no one wants to invest and go into capital producing goods. Basically, NAB do a survey every month and business conditions all across the nation are basically back at GFC levels. Bottom line is that when the GFC did hit, Glenn Stevens cut interest rates to 3%. And at the time, he said it was as a result or in response to catastrophic economic conditions. Those are his words, not mine. You guys can basically read into it yourself, the fact that interest rates today are 50 basis points lower than that and are in all likelihood going to head to 2% or even lower next year at some point. We are not at the end of the GFC. We've actually got very, very serious problems to deal with, and every day that we delay them, we're only making the problem worse. And what that means is we need to all be very, very careful about where our money is invested, because there's never been more investment risk in the markets right now. If markets were basically at all-time lows, we could actually say the majority of this has been priced in. But nearly all around the world, markets are actually closer to all-time highs, which is why there's so much risk out there. Now, I know most of you are all obviously university students. You won't have huge portfolios or anything right now, but to try and give you an illustration of where your money might be or might be going, the easiest thing I could think of to show was basically, some of you will be working now or you're about to go out and start working, so you are going to end up with a superannuation fund, whether you like it or not. In terms of basically how your money is going to be invested with one of those, unless you do something different and take control of it yourself, you're going to end up with a portfolio that looks something like this. 58% of it's going to be in equities, 22% of it in cash and bonds, basically 10% in property, and then a little bit in things like alternatives. You'll have absolutely no gold in there. There's not one superannuation fund in Australia that has had even a 1% dedicated allocation to precious metals across the course of this bull market. Yet they are still called investment professionals, funnily enough. So let's have a look at the outlook for all of these asset classes in the coming years and whether or not they're really cheap or whether or not they're expensive and actually there's pretty significant risk. Let's start by looking at the share market. Now, is everybody in the room familiar with what a price-earnings ratio is? Yes? Great, okay. So if we look across the course of the last 130 years, we can see that based on, this is the S&P 500, so the US stock market, we can see that on average, the PE ratio for the market has been about 16, meaning people have been willing to pay about 16 times earnings to be in the market. But as you expect, markets go through bulls and bear cycles, people get super exuberant, people get super despondent, and so this thing moves around quite a bit. And as you can see, at various points in history, when people have been super bullish, they've been willing to pay 25, 35, at one point even 45 times earnings. When they're super bearish, nobody wants to own stocks. The PE ratio for the market tends to drop down to somewhere between 5 and 10. As you can see where we are today, stocks are basically trading at 25 times earnings. That's not cheap, guys. They've only ever been that expensive 2 or 3 times in history. And in fact, what's happened the last 3 times stocks have been this expensive is that there's been a 67% fall, a 78% fall, and a 61% fall. Here we are today facing economic risks significantly more challenging than the environments where all of those losses occurred in the stock market, yet everybody's telling us that stocks are cheap and we're at the start of a new bull market in equities when they're already trading at 25 times earnings. They may be accurate, but I'd be very, very cautious about believing that at face value because the likelihood is that there's significantly more downside than upside in the stock market in the coming few years. Let's move on to the bond market. This represents US 10-year bond yields or borrowing costs for the United States government. And as you can see, obviously yields move inverted to price. So we've had yields falling for pretty much 30 years uninterrupted. Generally speaking, if something's been in a bull market for 30 or 40 years, the next 20 or 30 years are probably not going to be that encouraging. Look, we had a bear market in bonds that basically went for 30 years, bull market for 30 years. Chances are bond yields are going to rise in the year ahead. Problem is, if bond yields were to go back to even 6%, which is the long-term average borrowing cost over this point, it would basically close our economy down because the United States government owes so much money now that even a 1% rise in borrowing costs represents $170 billion a year in additional interest payments on the national debt. That's why, another reason why we have to keep printing money, because the only way to keep bond yields down is by central banks printing the money to basically provide a buyer for this debt. Either way though, either central banks stop printing money, bond yields rise and you lose the capital value of your bonds, or they keep printing money and you'll lose to inflation because the actual coupon payment you'll get for lending to the US government or most sovereigns now is the lowest it's ever been at a time when they've never been more indebted. Or another way of thinking about it is you have never been paid less money to take on more risk. That is the exact opposite of a sound investment. And last but by no means least, let's look at the property market, which I know most young people in Australia are absolutely looking at and going, well, I'll never be able to afford a house. I think you will be able to at one point because I suspect that property prices may well correct significantly in the next few years. The consensus opinion right now is that because interest rates are at all-time low, property prices are going to boom again. But the reality is, if we look at this chart, it tells a highly different story. The red line is